Something that people need to keep in mind, and I'm not one who says necessarily that we are going to have a liquidity crisis anytime soon. I actually personally believe there's a probability of it.
In this insightful snippet, Rick Rule discusses the potential impact of a liquidity crisis on the bond market. He notes a shift in the approach to buying bonds for capital gains instead of income, emphasizing the historical demand for a 250-400 basis point real return. Rick hints at a potential 10% riskless interest rate and explores the implications for markets, including real estate. Urging listeners to consider their portfolios, he reflects on market dynamics, emphasizing that bear markets change prices, not values, and may shift assets from the weak to the wise. Overall, he suggests a critical evaluation of the liquidity crisis's implications for individual portfolios.
I think it continues to do an interesting thing to the bond market if that's what occurs. There's a lot of people who are advocating buying bonds now for capital gains purposes rather than for income purposes. I've never bought bonds for capital gains. I've always bought them for secure yield, but that's interesting. And I'm probably not smart enough actually to answer to your question in terms of what happens. My own suspicion, I remember once in conversation at dinner with Jim Grant about the delta between the natural interest rate and the manipulated interest rate. And he said that in history, private investors have demanded between 250 and 400 basis points real return. That is to say, a return above the rate of deterioration of the value of the currency. That would imply, if you agree with my ballpark assessment, that the deterioration of the dollar is clipping along at about 7%. A 300 basis point real return suggests a 10% riskless interest rate. Traditionally, things like 30-year fixed mortgages have traded at 150 basis point premium to the so-called riskless rate, which would suggest a first mortgage rate in the 11.5% rate. That would certainly take care of the problem of affordable housing. I'm not smart enough to tell you. I just think that it's a question that each of your listeners needs to ask themselves. And it is a question where I think it's increasingly urgent that your listeners consider in the context of their own portfolio. I mean, listen, I'm a believer that markets work. Our mutual friend, Doug Casey, once said that bear markets don't change the value of anything. They change the price. And they, in Doug's very politically incorrect fashion, he suggests that they return goods to their natural owners. From the weak and the stupid to the strong and the wise. Now, somebody who bought a building for $65 million and has to sell it for 15 or 16, the person who bought it for 65 doesn't feel so good about the transaction. The guy who bought it at 15 or 16, he probably doesn't feel so bad. And as a consequence of the cost of capital for him at the $16 million valuation, that allows rents to fall. So the tenants probably feel good about it too. It resets property tax much, much, much lower, which I think is great, but the government might not like so much. But if you think about all of this in the context of your own portfolio, that's what becomes important.
In this next discussion, Rick Rule raises a thought-provoking analysis on the potential risks facing investors, especially those relying on high-yield investments. He points out a generation of yield whores drawn to high-yield ETFs with short-term credit risks. Rick warns of a liquidity squeeze, comparing it to our bonds, where selling illiquid assets becomes challenging. He questions the sustainability of past yields in a changing financial landscape. Emphasizing the need for self-assessment, he encourages viewers to consider their portfolio's resilience in the face of a liquidity crisis. Rick concludes by discussing the increased challenges for the government to print and spend its way out of economic downturns due to soaring on-balance sheet liabilities, signaling a potential shift in the financial landscape.
There's a whole generation of Americans whose thoughts of the future were generated by the last 40 years, a period that was very benign with lower interest rates. And this whole generation of Americans, among other things, has turned into what I so inelegantly call yield whores. People who buy investments based on the amount of distribution it gives them to sustain their current lifestyle. And many of these people have been lured into so-called high yield ETFs. And these high yields are obtained by taking short-term credit risks. You have these high yield ETFs that are extremely liquid and are owned in $10,000 or $20,000 chunks by middle America. The problem is that the underlying assets, over-the-counter bonds, are highly illiquid. And if we have any of the sort of constrained credit market that you describe, if we have the sort of liquidity squeeze that we had in 2008, which I don't think is unlikely, and you have middle America bailing out of these high yield funds, which are very liquid, and the fund manager trying to sell the underlying assets, which are highly illiquid. I think we described this, you and I, in a previous conversation as owl bonds, which is to say bonds where when the portfolio manager calls the broker and says to sell, the broker says, to who? And I say this not to get your audience to laugh, but rather to consider what's in their portfolio and what assumptions went into buying it. If the whole assumption was yield, you need to wonder what the probability is that you continue to enjoy that yield in the next 10 years, where the circumstances that you're confronted with are very different than the circumstances that you were confronted with over the last 40 years. You know, if you if you give a pretty good salesman like me the use of the word could, I can sell you anything. What I prefer that your listeners thought or thought about was, is there a probability or a strong possibility that that would occur? And if there's a probability or strong possibility, is your own personal balance sheet, your portfolio, does it take that into account?
Yeah.
Coming into 2008, did you have sufficient liquidity so that when a liquidity crisis hit, you had the ability to take advantage of the situation, or were you taken advantage of by the situation? People need to look at their own portfolios. We've discussed liquidity before. People say, well, I don't want to have savings because, as you say, the interest that I earn on my savings doesn't match inflation. My suggestion to those people is that the purchasing power decline that they suffer with interest should be considered an option payment on having the liquidity to take advantage of a 2008 circumstance rather than being taken advantage of. Something that people need to keep in mind, and I'm not one who says necessarily that we are going to have a liquidity crisis anytime soon. I actually personally believe there's a probability of it, but as you and I have talked about before, Doug Casey and I between us have called 17 of the last 3 declines. So I'm always concerned. I'm a credit guy, you know. But think about this, and I hope your audience thinks about this. When we went into 2008, government debt on balance sheet, not off balance sheet, on balance sheet liabilities of the US government were about 25% of GDP. In other words, the government still had the ammo to push on the string. Recourse liabilities of the government now, full recourse, which is to say on balance sheet liabilities of the US government, now exceed 100% of GDP. Mm-hmm. So the necessary ability of the government to print and spend their way out of a circumstance is materially diminished. I'm not trying to say that the confidence in the US economy doesn't exist to the extent that they wouldn't be able to do it, but it would be much, much, much more challenging from my point of view, just because of simple arithmetic. Debt as a percentage of GDP has quadrupled, which means that the financial flexibility has probably declined.
In today's insightful discussion with Rick Rule, We delved into the potential shifts in the bond market and the risks associated with buying bonds for capital gains rather than secure yield. Rick highlighted the historical demand for a 250-400 basis point real return and hinted at the possibility of a 10% riskless interest rate. The conversation also touched upon the challenges facing a generation of investors drawn to high-yield investments, emphasizing the liquidity risks in high-yield ETFs. As we navigate the complexities of the current financial landscape, Rick encourages each viewer to assess their own portfolio's resilience, especially in the face of a potential liquidity crisis. The discussion prompts us to consider the sustainability of past yields in a changing economic environment. Remember to subscribe to our channel for more thought-provoking discussions with finance experts like Rick Rule. Don't forget to hit the like button if you found this information valuable, and share your thoughts in the comments section below.